Hello and good morning to the DecisionPoint trading room. My name is Erin Swenlin, and I am here with my father, Carl Swenlin from DecisionPoint. And we're going to show you the charts that we think are important for you to see going into this week. We have some interesting developments today with a little bit of a rally that started out after Fridays. So we'll be looking at those charts. If you want to ask us a question or put in a symbol request, just use the Q&A box, and that way we'll see it. The chat room is for you. We do have a moderator in there, so go on in, get to know some of your fellow traders and see what trades are on their mind in the chat room. All right, without further ado, Dad, I'm going to pass it to you and let you talk about the market and what you're seeing in those mega caps as well.
Okay. All right, let's start out with what the market is doing right now. I'll update this page. Notice that the Dow, S&P 500, 400, 600, and Russell 2000 are all down. The New York Stock Exchange Composite is down, but the NASDAQ 100 and NASDAQ Composite are up. So let's take a look at the Dow 30 and Microsoft, Cisco, Merck. And at the bottom, we've got J&J, Nike, Goldman Sachs, Intel. So in general sense, we've got basically, it looks like tech is rallying right now, not by a whole heck of a lot. But let's start with Apple. We've got, notice it broke down quite obviously. We had this very steady rising trend line, and it finally broke down and big time, and we're down about 13%. We've been down about 13%, getting a little bounce as of Friday. Amazon also correcting downward. It was up earlier today, but you notice that they're backing off. Most of them are backing off from what they were doing earlier today. So the tech sector is holding the market up somewhat, but it's running out of steam already. Got this island reversal here for Google potential, and we would, now that I look at it, I'm not so sure that we haven't fulfilled that bounce, that gap back down. I think to be a total reversal, it'd have to be jump the gap right here, or something like that. But anyway, that's probably going to go down some more. Meta, also like Apple, had a very steady rising trend, and it finally broke down. Microsoft, we've got a saucer with handle formation, a very large one. Doesn't even fit on the 1-year chart. And we'll see. I think the handle could correct as far down as this. If it goes any further than that, well, we can forget about that formation, because we'll be looking at a bearish chart by then. Netflix, head and shoulders pattern broke down through the necklines, so it has executed. Minimum downside projection would be about here, would be 350. NVIDIA, this is the one that's causing all the rally elsewhere and all the indexes. Over 4.5% up today. Notice it's rallying back to a declining tops line. So, and of course, this is the preeminent stock for artificial intelligence discussions right now. But again, that is all what is perceived by market participants. We don't know how much meat there is on that bone, but that's what it's been rallying on. And I think it's going to not fulfill the prophecy for a while. Not saying it doesn't have a permanent spot in AI. It's just that I think it's been overhyped. Look, we've got a PE of 235 right now. I think forward PE is, I heard on the TV today, was about 50. So it's really quite overvalued. And of course, Tesla, also a big rally today. Notice that the 20 EMA has crossed down through the 50-day EMA. So that's a dark cross neutral signal on this stock. And you'll notice it's coming back down to a rising trend line. But I'm becoming more enamored with horizontal support lines, and it's bounced off this one right here, which is good for the moment. Last week, I had some nasty things to say about electric vehicles, and we had a comment. The fellow said, I have an electric vehicle and I really like it, which I am certainly, there are many people out there that like their electric vehicles, and more power to you. I just think, broad strokes here, I think it's a market that's going to finally hit the wall. I think it's down, mostly down from here on out. That's just my opinion. All right. Let's just take a look at UNG. Right now we've got a saucer formation. I don't have a lot of faith in anything bullish on this chart, but it's going to turn around for a while. Ultimately, I think we've got a lot of upside, but something's got to happen to trigger that. We're not going to stop using natural gas. We're just not. Okay, let's look at the market. SPY, we have, it's slightly down. It was up earlier, and notice we've got a declining tops line. So any rally would be probably stopped by that line. And of course, we've got the horizontal resistance right there. I'm going to go right to our intermediate term and short term indicators, our primary indicators here. Short term was Swenlin trading oscillator for breadth and volume, and it has gotten quite oversold, but it really can go way worse than that. So this is kind of average for the last 10 months or so, but we still have potential to go lower. For the ITBM, IT breadth momentum and volume momentum indicators, they are finally becoming slightly oversold. Here's a bull market oversold level. Here's a more bearish oversold levels for here. So I think I'm expecting it to go down to at least these levels here, but it can get a lot worse, as you can see. Here's the dollar. Let's look at this, look at a 1-year chart and see what we've got. Okay, basically in a trading range, you could make a case for a slightly rising trend channel, but I think it looks like it's stalled. Gold, all things being equal, gold should move the same percentage, but in the opposite direction as the dollar. We keep track of the relative strength of the dollar using UUP versus GLD, and that this line shows us that gold is actually weaker than the dollar is strong. So there's some trading problems with gold. Correlation, gold normally is negatively correlated with the dollar. Oil had a rising wedge, broke down from that, and met that bearish expectation for that formation. Now is trying to rally some more. TLT, 20 plus year treasury bond, in decline. And let's look at a 1 year chart. Okay, it's coming back down to this level probably. The 10-year treasury yield rallying today, and that's a saucer formation. So we could maybe look for a handle in a few weeks. Yields are generally in a rising trend, and they're inverted. Here are the short yields paying the highest, and the longest paying the lowest. Looking at the 30-year mortgage rate, it's now it's just slightly higher than that top rate last year. So we're at about 20-year highs right now. As I've said before, when I bought my house, interest rates were at 7.25%, and they had been that way for quite a long time. Nobody thought it was a great burden. And the only reason it seems a burden now is because of the ridiculously low rates that the Fed had on us for so long. I saw in my notes here, the Redfin CEO, I saw him last week on Fox Business, and he said housing market has hit rock bottom. Okay, now when somebody like Redfin CEO, he has an axe to grind. So I take whatever he says with a grain of salt. Most people you see have an axe to grind, so you have to look around and see what else there is to be learned about that. I don't think the real estate market has hit a low, a rock bottom by any means. And what's been happening, and let me just talk about this chart. This is the Home Builders ETF weekly chart. Notice we've got a pretty good, solid looking double top here. So I'd be looking for support in this area to be challenged. But the problem right now is that people have homes that they value pretty highly, and that was based on interest rates of a year or two ago. They can't get it now because I should have that chart, but I don't have it right hand. But people buy homes based on the monthly payment. Most of the time, most people have a budget, and they'll squeeze it right to the edge, and that's all. That's all the higher they can go. So when interest rates go up, the house that they can afford, the price of the house that they can afford goes down. And right now we've got people who would like to sell, but they're not putting it on the market. The inventory is really low. Prices are staying high, and inventory is really low because they don't want to sell it at probably about half of what they think it ought to go for right now. And that's basically the problem. The high interest rates are squeezing buyers out of the market, and sellers do not want to give in to the prices that they can really get at this point. Okay, have I forgotten anything?
I don't know. Did you get Bitcoin? That usually is the one you like to forget.
I did. I forgot it again. Well, here's one I wanted to talk about. Peter Ides was on Cavuto last Friday, and he had this ratio that he worked out, which is the NDX divided by the Dow Industrials. And basically, he has picked 45.45, which is 45%, the ratio, and as a tipping point, more or less. But the first time it hit that level was in 2000, and from the top it declined 85%. This is the end. This is, I'm sorry, yeah, the NDX declined 85% from that 2000 top. Others, the S&P was down over 50%. Industrials were down about 40%. But here in 2021, it also went through that 45 line and came, and we had a pretty good correction. And the NDX, I think, was down about 35-40%. And here it's just recently, say last month, I think, it pierced the 45% level. So based on history, we might be expecting a worse decline than I'm hearing people expecting on the TV. Now, let's be realistic here, though. We have 3 data points, 2 which have a result, but that is not nearly enough to make too solid a broad generalization about this indicator. But basically, it's showing the NDX, which is the go-go index, and the Dow, which is the more conservative index, and showing that the NDX is getting way ahead of the Dow and in its valuation. And with that, I think, yes, I think I will pass it back to you, Erin.
All right, sounds good. Thanks for that very thorough look at the markets and the mega caps. I am going to share our website very quickly here, because we're running a big sale currently. So we have 2 reports that we do. And the first is the DP alert, which is basically what Carl just did. We go through the market in general. We pull out something, a chart of interest to lead with. And we cover Bitcoin, the dollar, gold miners, crude oil, interest rates. All of that is included every market day in the DP alert. DP diamonds is kind of goes hand in hand. I give 10 stock picks per week, including 3 ETFs for ETF day. And they give you an idea of stocks that will probably ride the tide fairly well based on what we're saying in the DP alert. So like I said, we are running a big sale right now, and you can take advantage of it only until the end of the month. So let me see here if I can get that in here. All right, well, that's the wrong chart. But basically what we're doing is we're running a buy one, get one free special. Let's see if I can get back on that chart. I don't think I can. No. Go back. There we go. Buy one, get one free. So basically, if you purchase any of our subscriptions right now, between now and the end of the month, you don't need to use a coupon code. We will add a free month after you check out. So you'll get 2 months for the price of one of our DP alert reports, whichever one you want. So I wanted to share that with everybody before we got going. But do take advantage of this right now, because it will be going away on August 31st. All right, let me get to my section. So what I usually cover in the DP trading room is I'm going to go through the sectors in broad strokes. Then we're going to dive in and look at some of the industry groups. And I will tell you that it'll be a quick review of the industry groups because there aren't very many that are showing positive momentum right now. There really isn't a whole lot of places to hide currently. And it's not a surprise when you look at what's going on all of the sectors. And you can see all of them here on one page. I have the PMO on the bottom here, and you'll notice that with rising momentum, there is no rising momentum. It looks like energy is getting a little bit of a tip to the upside here after a little bit of a rally going on in crude oil. I would be very careful with this area, though. It does look like crude oil is going to resume its rally, but we can't be sure. And that's going to put downside pressure on this one sector that is performing well. Healthcare was really the only one looking good last week when we were talking in the DP trading room. And since it has turned south and has now formed a very ugly double top formation, these formations, when you get the confirmation of the price going below this confirmation line drawn from the middle of that double top right there, when it goes down below that, the minimum downside expectation is the height of that pattern. And that could take us down to levels that would even test the lows from back here in May. So be very careful with this particular sector. Things are not going the right way with it. And if you have any positions in that area, you'll want to keep an eye on those. Financials still hurting. I mean, basically all of these, you can see the turn and these rounded tops on the price on most of these sectors. The one that is somewhat interesting to me is utilities. And it's not that I think it's such a great sector right now, but I want to show you the charts here. So let me get into the right area. So utilities are interesting to me because they're hitting some longer term support here back from these March lows. Now, this does not mean that they are going to reverse here. In fact, they are trying to drop below that level currently. But it's one sector that really, you know, the fact that it is hitting these lows might have the opportunity at a reversal. But I'm really not seeing anything on this chart to tell us that we're going to get a reversal. This is just eyeballing it and seeing that we are at these lows that we had back here in March and April. So definitely a sector to keep on the radar, but certainly not a sector to dip your toes in the water yet. Technology, we've been talking a lot about. It is having a nice rally today. But overall, this sector is still incredibly weak, and it could get weaker. I say that it could get weaker because when we look under the hood here, we have the price stocks above their 20-day moving average, 50-day, and 200-day EMA. So this tells us what the participation is currently. How many stocks have price above their 20, 50, and 200? And currently those percentages, while they are oversold-ish, they certainly could get lower. We haven't seen that much lower readings from the percent of stocks above their 20, but we still do know that they can get much lower. And in fact, back here, I believe we hit the 0% level. So there is still room for more weakness. When you look at our Golden Cross Index and our Silver Cross Index, first, let me explain the Golden Cross Index. Basically, a Golden Cross, I think most of us are familiar with. That's when the 50-day EMA crosses above the 200-day. I should say moving average because it doesn't matter. Most people, anytime the 50 crosses above the 200 moving average, it is considered a golden cross. So what we decided is, why don't we measure how many stocks have price above have the 50-day EMA above the 200-day EMA. And that is what the Golden Cross Index does. You can see that in technology, it has turned over. We're getting ready to see a bearish shift where this goes below its signal line. So that is looking very weak in the longer term. And certainly this indicator has been much, much lower. It takes a long time for it to make its move, but seeing this turn on the Golden Cross Index in overbought territory should give us all pause. The Silver Cross Index measures how many stocks have a 20-day EMA above the 50-day EMA, because we call a 20 and 50-day EMA positive crossover a silver cross. It gives us an intermediate term picture. And so you can see that the Silver Cross Index has been in decline. This looks very much like the SPY and its Silver Cross Index. It is at 55%. It could go much, much lower. We have to look at how many have their price above the 50-day EMA, because that's your threshold. As long as price is above the 50-day EMA, you're not going to lose your silver cross. It'll at least stick around. Doesn't mean that you're going to get a new one on the stocks that are sitting there, but at least you're going to be able to hold a golden cross if you have, or a silver cross. So that is only at 33%. We know that that can move lower. So I still see a lot of weakness within technology. And though we are getting that rally today, we're still in a declining trend. I don't see any breakouts going on here. And notice that the silver cross on technology is about to be lost. So there is still a lot of weakness going on within the market. Technology, like I said, is seeing a rally today, but I wouldn't count on too much coming out of it. Really, with the way the indicators look, they are starting to get oversold. But I am of the opinion we're going to see more of a pause in this decline rather than a reversal rally. But that's my opinion. All right, let's go ahead and look at the industry summary. Where is their pocket? Where are pockets of strength? And like I said, I haven't been able to see too many. And I think it's important that I do arrow through a lot of these, because you can watch over here on the chart as we go through each of these industry groups where the PMO is, what price is doing. And you'll notice that there really isn't any bright spots out there. Here's comm services. Look at that PMO turning down. Fixed line telecommunications and mobile telecom were two areas where I saw some possible movement. At least the PMO is on its way up, but price really isn't reacting at this point. Internet, this is where Google is, and you can see that it is falling. It's having a good day today, more than likely because of Google. Mobile telecom, like I said, showing a little bit of positive momentum, but really price action isn't telling us that there's anything we should act on in that regard. Here's consumer discretionary, pretty much everything in decline. The only place that I've seen a bright spot here is when we get down here to apparel retailers. But as you can see, all of these, the PMO is headed lower. Apparel retailers actually have a pretty nice look. I did your daily 5 this morning, and I suggest you go back and look on YouTube and watch that, because I did talk about apparel retailers, and I did throw a stock out there for you to consider within that group. But ultimately, there really aren't a lot of spots that are showing any kind of positive movement here. Consumer staples is an area that I would have expected to start showing some strength, but as you can see, no positive momentum existing at all here within consumer staples. So it's a defensive group, but it hasn't been reacting like one. Energy, like I said, the one bright spot as far as the PMO on the sector chart, but notice the PMOs are all topping here on the industry group charts. So there is internal weakness within energy that we need to be aware of. Coal is topping out here on that PMO, even though we have a nice looking rising trend, and it is above the 200-day moving average. So maybe you can find a little bit of action in coal, but a lot of this rally has made the run. So I don't know that you want to get involved just yet either there. Financials looking pretty bleak. No industry groups with any kind of positive momentum. I mean, it's just pretty ugly out there, folks. I'm sure you know, as you have been watching and trying to fill your portfolios, there's just not a lot of choices. And here's healthcare. Biotechs had been showing a nice rising trend. They broke down beneath this rising trend. We are seeing a pickup here a little bit on that 50-day moving average, but that PMO sell signal would have me very worried about my biotechs. And again, nothing here. Pharma has rising momentum, but it does look like it's topping out. And knowing what the sector chart itself looks like with that big double top, I don't think I would trust pharmaceuticals. Industrials, again, nothing in here that looks, I mean, I guess defense looks okay with the PMO flattening out, but price is really not doing anything. And we have kind of a rounded top here. So not anything that I would be wanting to take action on there. It's just ugly all the way through, and industrial is no exception to that rule. We look at materials. Again, these are some of the areas I would expect to see a little bit of positive action, but nothing out of materials currently. We know that gold has been troubled, and mining is not going well as far as the regular mining, the general mining, and gold mining also looking very weak. Steel, there have been some news of some mergers out there, started to get a little bit of spotlight, but ultimately we do see a rounded top here. So we have to be very careful within that industry group. Real estate, again, these are just terrible looking industry groups. There's nothing in here of any interest. Where do we go? There's just not a whole lot of places. So technology is seeing the rally, but look at these industry group charts. They're all very, very ugly. This would be an exception in telecom. And notice in the first sector we looked at in comm services, there were a few telecom groups that were looking interesting. So maybe this is an area that you could explore, but be very careful out there. But telecom looking okay. But that is about it. Semis, software, not good. Utilities, which I said are hitting some lows, but I don't see any action within these industry groups that tell us we can go fishing there. It's just more of an interest in seeing what we have. So at this point, I'm not seeing a whole lot of positive activity. If we want to go within telecom, which is breaking out, let's go look very quickly at a few of the stocks within. If there's anything of interest, I can go here, organized by the stock charts technical rank. That's going to give you the stronger stocks at the top. And if we just go down and hover over these symbols, it gives you some possible areas. Palo Alto Networks, big gap up. Maybe this is causing some of that nice rally going on within technology. This was a reverse island situation. I would have looked at this chart and not expected a reverse island situation, but that's exactly what we got. Price already getting close to this overhead resistance area, but I have to say Palo Alto Networks looks okay. Arista Networks is in a pretty nice rising trend at this point, but the PMO looking a little weak there. And Extreme Networks, not good. You can see that that decline is going on in Extreme Networks. I'm not seeing too many charts here of major interest. Cisco, which we know is one of the leaders today, is looking healthy enough. You can see it's very much outperforming its industry group. So Cisco looking okay, Palo Alto Networks looking okay. All right, with that, I think we're ready to do some symbol requests and answer some questions. Did you see anything of interest you wanted to answer?
There was one question, and you caught me flat-footed here. Get back on the right page. Okay, question was, are income-oriented sectors like XLU and XLRE a good buy in a high-interest area? They get hurt both ways. Cost goes up, and investor has a choice to seek fixed income and money market. Let me just comment that on real estate. We've commented that earlier, what a mess that is. There was a comment on the on Fox Business today. A person said that a place to look would be the REITs for apartment buildings, because there's just such a shortage of housing out there. Apartment buildings would be a good area to get into. I'm not endorsing that. I'm just saying that's an idea.
Yeah.
Do you have any comment regarding the?
Yeah, that would be interesting, actually, to go back to this industry summary. We looked at real estate, but let's look at some of the REITs that are within there. I think that that would be useful. So diversified REITs, not looking that great. We've got hotel and lodging REITs. I don't see anything there. There's your industrial and office REITs, not looking good. I can imagine that's going to be a problem. Here are your mortgage REITs. And at this point, there is still more levels to go down. We have a little bit of support here. Retail REITs still looking pretty sad. Residential REITs is the area we're talking about. And I don't see, I mean, we just lost this support level here. So maybe this is a watch list material for you. We are getting ready to hit some support on residential REITs. Might be an interesting area there. And specialty REITs, we are hitting some lows here. So maybe these are groups that you might want to keep on your watch list. But currently, I don't see any possibilities for any buys.
Okay, there's another one here. Can you look at breadth indicators for small and mid caps? We have charts for that. If you're a StockCharts.com subscriber, you can find sets of indicator charts for the small and mid cap stocks, but I don't have any charts that are ready for prime time at this point in time.
Well, I think we can look at, we wanted to look at mid caps and small caps.
Yeah, but
we can use, so these charts are available on our website to subscribers. They're already put together, so you don't have to go searching for the information on these. And these are updated every day and every market day. So you can take a look. But we don't have the indicators necessarily for the short term, and we have the Golden Cross, Silver Cross for these areas, but still looking pretty weak. Where's the small caps here? And I do have the short-term indicators. I think I have a list, but yeah, we'll have to look at that maybe next time.
I made a note of it.
Okay, perfect. So stay tuned.
We do have these charts that you're showing. They have the Silver Cross, Golden Cross, and then percent stocks above 20, 50, and 20 EMA. I'm sorry, 200 EMA. I need to correct that.
Oh, yeah, I just noticed that.
So these are really, I think, the best breadth indicators available, really, if you wanted to look. But we also have new high, new low charts for those indexes, as well as the raw breadth of advances and declines.
Yes. All right. You can't see.
Another question.
Oh, yeah.
Is there an alternative ETF to UNG that issues a 1099? I'm not sure what you'd refer. I think what you're referring to is a K1.
Yeah. And I don't know if this is another natural gas ETF. You can see it trades very, very low volume. And I don't know if they do a K1 or not, but FCG is another possibility for a natural gas ETF that's out there.
Right. And the UNG, you can get a K1 for that. You'd have to get a K1 when you file your taxes on it, but check with your CPA. We're not tax experts here.
No, definitely not. Okay, just experts at paying them, I guess.
Okay, how about
let's go ahead and get some of these symbols going.
KMB.
Okay, so we are hitting some lows here. Let me go ahead and get my inspect tool up. So we drop below this level of support, and the next level of support that's available really is right around here, and we haven't gotten there. you can see, let's see, where is this lining up? It's not really lining up with a strong support level. It does look interesting as it's making this turn, but you can see that the PMO, while it was turning up, is trying to turn down beneath its signal line right now. And we're not at a real major support level. So I would be really careful. This is in that defensive area of consumer staples. So I know a lot of people are looking over here to find some possibilities, but notice that death cross that's just occurred here. I don't like the look. It is trying to turn, but I don't see enough information here to give it a bullish stamp of approval.
Okay, RX for long.
All right, a biotech. As we looked, the biotechs and healthcare are starting to really break down right now, so I would be extraordinarily careful. We have this big gap support area. It dropped beneath this support level already. The next level is right here at that gap, and we haven't reached that level. So this may look like it's a turn, but like with Kimberly-Clark, I don't think we can make these, count on these turns. And we have to be very careful, especially about bottom fishing right now. Certainly there are stocks that have been beat down and maybe are getting ready to make the turn. But this one is a big worry when you have this type of decline that's so forceful, and this is only just a little bit of upside right now. I would be very careful here. You can see the PMO is in decline. RSI is in negative territory, not oversold territory. Oversold would be below 30, so we're not there. And notice the relative strength of this particular one. The group itself is evening out its outperformance. It was outperforming biotechs, and like I said, we saw that chart. It is starting to flatten out, look a little bit suspect. But this one is not performing well against the S&P, and it's not performing well against its industry group. So you're really at a disadvantage with this stock. I don't like it.
OIH.
All right. And I think that one was listed as somebody wanted to short it.
Oh, yeah. Mm-hmm.
Yeah. And I can certainly see that. We're losing this support level. It hasn't totally broken down because we do have this sort of near-term support that it hasn't broken, but I would be watching. And if it did break down, I like it as a short. Right now, though, this is an oil services. And like I said, energy has been clicking. It is starting to look a little bit vulnerable. And this chart is one of the reasons why. I can certainly see this as a possible short, but I really would want to see the energy sector as a whole start to turn down and lose its positive momentum. Because right now, if we look at the energy sector chart, which I did not do, and I apologize. If we look at this chart, notice that the PMO has actually turned down and has given us a sell signal. So that's good. And when we're looking for a short, like we're talking about here. So I could definitely see this as a possible short based on what we're getting. The stochastics are moving lower. So let's look at a 5-minute candlestick chart, because now we're going to want to look on the other side of things. When is it that we want to buy a short position? Well, when I come to a 5-minute candlestick chart, I'm paying attention to the 5-minute PMO and 5-minute RSI. When I'm on the sell side, I'm looking for the PMO to start turning over, and I usually don't wait for a negative crossover. We've had that already, so our short position, best buy point, if you will, for the short is back here on this particular candlestick. So we're much lower than that. The PMO is trying to make a turn here, so you might be able to get in on a rise to get a little bit better of a sell point, but this looks pretty ugly, and you might be just stuck with this as your sell point or your buy point for a short position. I'm not seeing anything that's helpful to say wait around necessarily, because the PMO doesn't look positive enough to wait around to see if price is going to reverse in order to get a better buy point for your short.
STNE.
Stoneco. This is in technology. Another one I'm guessing that we're looking at as a possible buy, because we're getting at these lows and this support level. I mean, the PMO is in decline on a sell signal, and it's not oversold by any stretch of the imagination. The RSI is negative, and it is also not oversold. You are seeing the relative strength failing against the S&P and failing against the group. The group is actually showing a little bit of relative strength as it rises in software, but I'm not seeing anything good on this particular chart to want to get involved. If I own this one, I could see a hold. Let's see, where would my stop level be? Best stop level would be down here, and that's almost a 10% decline. So I know I wouldn't want to be sticking around for that. Maybe this gap support level at about 5% would be a place that you could set your stop if you haven't already. But you already, if you're holding it, you've already had to digest this big decline. I don't know that you want to continue to hold on to a loser. And this one looks like it's going to continue to lose based on that PMO headed lower.
Okay, and I just had a thought of something I meant to mention when I was talking about NVIDIA. Yeah, they're dropping earnings they're coming out with earnings this week, so something to know.
Right. And that could work in its favor or against it.
Who knows?
Yeah, and personally, I don't like to hold through earnings, because you can get good reports and then still get a big gap down. You're just highly, highly vulnerable to volatility. And I know I'm not interested in holding stocks when I know they're going to have some volatility.
Okay. M.
Macy's. Big decline here. This is a broad line retailer. And if you recall, it was the apparel retailers that were looking good currently. I don't like Macy's. I hate to tell you guys, I have a feeling just about everyone you're going to bring to me, I'm going to say that I don't like, but that's because all these PMOs are in decline, and I don't like to get involved in anything with a declining PMO. This one, in fact, the PMO has dropped into negative territory. It is not oversold. We could certainly see more downside here. Stochastics are headed lower in territory below 20. Now, I don't look at stochastics as overbought and oversold, because they're really more of a characteristic internal strength, internal weakness. And when it's above 80, you want it to stay above 80. So that's why I don't consider it overbought, because you want price, or you want the indicator to be above 80. You want the indicator to not be below 20, because that's showing extreme weakness. It doesn't mean that it's oversold. And you can see that relative strength, especially when you look in this thumbnail, is declining. This is not a good stock. It's in a decline. I don't even see a little bit of a reversal here. It is sitting on this support level right there, but there's the stronger support level, all of those lows, and we're still not there. It's another 3 to 4% decline to get to that support level. So maybe you want to put it on a watch list so you can see when it finally does turn, because it would be a bottom fish for you. But looking at these EMAs, there's really just nothing good on this chart, I'm afraid.
PAYC, and kind of divergence with MACD and RSI to some extent.
Okay. This one has been getting a lot of action, I've noticed, in the trading room. I had it looked at in the DecisionPoint Diamond Mine on Friday. I do a 1.5 hour trading room for my DecisionPoint Diamond subscribers. So if you like the trading room, this would be an opportunity for you to get an extra trading room per week by becoming a Diamond subscriber. And remember, buy one, get one free right now. So get over there and get your DecisionPoint subscription started, and you'll get 2 months for the price of one. Okay, enough marketing. Pacey. So what did they want to see? The
MACD and
PMO divergences?
yeah, RSI, I think it was.
Okay. So right now the RSI is just above oversold territory. The PMO is trying to decelerate a bit here, but this is a declining trend. This isn't looking like a turn. Right here, I would have been a little bit more bullish because you had kind of a cup shape there or a little V bottom. But now it tried to make the turn. It was unsuccessful, had another decline. I would see this as a possible turn with another not successful breakout. We're getting a death cross lining up here. And as I said, the PMO may be decelerating a little bit, but this, I don't see support until down to this level right in here at these lows and this low. Yeah, there's some support here at this low right there, but that's about it. I think you're vulnerable to more downside here on Paycom. I wouldn't be looking for a turn yet.
I would like to comment, the MACD would not be as good an indicator as the PPO or the PMO or PMO. Those two are ratio calculations, and you can compare PMO readings current day to PMO readings years ago, because it has to do, again, it's a ratio. So with the MACD, it depends on how big the numbers are, what price, how big or small the price is, depending on how far it's going to go within a range, and you can't compare them over time.
Right, I agree. We think that, of course, the PMO is the best, but the PPO is a relatively good facsimile versus a MACD, which isn't normalized.
Okay, IJR.
IJR. Let's actually go ahead and go back to our chart that has the indicators underneath the hood here. All right, so IJR is getting ready to hit some relatively strong support here at these lows and at this top, this low. But it did drop beneath the 200-day EMA, which is also a support level. So it dropped beneath that first support level. PMO is almost in negative territory. We did see just a slight increase here on participation of stocks above their 20 and 50-day EMAs, but not a significant amount. These percentages are also not oversold. Here's oversold territory way down here for these indicators. There's oversold back here. So we're not quite there yet. The Silver Cross Index is in decline. The Golden Cross Index is getting ready to have a bear shift beneath the signal line. Stochastics below 20, like I said, very weak. And look at relative weakness. You'd be better off in the SPY. Not that I would say you should go to the SPY, but you would be better served there, at least, because the relative strength line is falling for IJR versus the SPY. So this is an index that is weaker than the broader market here, or the larger caps, I should say, with the S&P 500. So this is not a place I'd want to be involved in. And you can see this is a pretty hefty decline, and a dark cross of the 20 and 50-day EMAs is on the way. So I'm not a fan of small caps here. We are hitting a level of support that could be interesting. Like I said, I think we're going to be looking at pauses across the markets, not necessarily relief, maybe a little bit of a relief rally, but not anything that I think will catch on based on what Carl showed you at the beginning of the program and our indicators, which are still looking quite bearish. Looks like we have a little more time.
question here. How much do fundamentals go into your analysis and decisions? Let me do that or start with it. The price chart should reflect everything that is known about the stock. Now, that being said, I still like to know what's going on. And if I'm contemplating buying a stock, I will go and look at the news stories and dig in and try to find out what the current news is about the stock and what problems or good things that might be happening. So that's to the extent, but you can still rely on the price chart to reflect everything that is known.
Yes. And I'm more of a technical analysis purist. I believe everything is pretty much baked into the chart, but I will say that you're at a disadvantage if all you look at are technicals. It's always a good idea to go in, dig in before you purchase a stock and at least know if they're doing well with earnings or not. Stock Charts has actually started adding earnings to their symbol summary. So let's look at Paycom as an example. So you can go into that symbol summary, just use the drop down over here to make it symbol summary. And then it'll take you through, it'll tell you when the earnings dates are, the last earnings. It gives you the floats on some of these. But down here, they've added earnings, and you can see what expected earnings were and whether they met it or not. And on revenue, same thing. So as you can see, Paycom in quarter Q2 did beat on earnings and revenue, but that did not come through on the chart when they reported earnings. So this is another reason why holding into earnings is really dicey.
AEM.
All right, gold mining. I want to take you to the gold miner chart because I think that it is a good example of what's going on here on this chart, but in general, you need to know what's going on in that industry group. And nothing good is going on in this industry group. It is getting ready to reach some near-term support, well, longer-term support. And I think it's going to hit that level because under the hood, you can see that there is no strength whatsoever. None. We only have about 4% with price above their 20, 50, and 200-day EMAs. And those stocks are the only ones holding a silver cross right now, where the 20 is above the 50-day EMA. And I don't like what's going on under the hood here for gold miners. Certainly with the Silver Cross Index, it's also in oversold territory, but it's still declining. I mean, this indicator you can see back here has hit 0 before, and I'm not seeing any improvement under the surface. Before I'd get involved with a gold miner, I'd want to look at this chart, which we do happen to have in every DP alert that we publish every market day, but I would want to look under the surface and keep an eye out for at least a little bit of action here. You can see where we got a bit of a heartbeat coming in back here before this rise, but even with the heartbeat coming in, we only got a little bit out of it this time and it moved down. We had a heartbeat come in and then we ended up with pause. We're not seeing anything here with a bullish outlook. So I would say your pick of, I think it was AGEM. I got that wrong, but anyway, the gold mining stocks, I say in general, should be stayed away from, at least till we hit some of the support levels down here at 26 for GDX.
25 seconds.
25 seconds. I will take you back to our homepage here. If you want to subscribe, we are running a buy one, get one free. So this is the time to do so. And in any case, you should sign up for our free newsletter. This will get you all of those free articles that we do publish during the month. And you can at least get a taste of what we do that way. That's all we have. So I would wish everybody good luck and good trading. And we will see you next week.